it's an insurance premium. People think about it that way. So when the VIX goes up a lot, we tend to say that the market thinks that things are more risky, right? So if you look at the VIX, for those of you that don't know what the VIX is the volatility index. It is you're using a calculation on options to figure out what is the volatility of the stock market, right? So how risky do people generally think the stock market is, right? You could look at it kind of like, what is the insurance that people are willing to pay for buying put options, right? It's kind of what the VIX is, right? So it's an insurance premium. People think about it that way. So when the VIX goes up a lot, we tend to say that the market thinks that things are more risky, right? So let's go back over the past year, and you can very clearly see here, when do you guys think the market was more risky, right? It's a very big spike in the VIX here. So what we could do is we could also modify the strategy to say, if the VIX is, let's say, above 21 or something, that it just doesn't trade, right? That way we're capturing most of it, but we're avoiding this big drop, right? And this, if you overlay this with SPY, you'll see it's correlated to the big drop in the market, right? So here we had this big drop in the stock market. If we had exited here when the VIX spiked, we would have saved ourselves a lot of money. And then same here, when the VIX spiked up a lot, we would have saved ourselves a lot of money. So if the VIX is above 20, let's just not trade. If we're above a 21 VIX, let's just not trade. Let's just not own anything, right? I think that would be a very nice thing to add in here.
Okay, like what you saw? See the strategies we've created in the marketplace, or create your own with our powerful trading AI at www.botspot.trade.